Hi, my name is Jimmy Sexton and I'm the president of Esquire Group. Welcome to today's segment on the Foreign Investment in Real Property Tax Act of 1980, or Firpta for short. What is Firpta? Firpta is a 10% withholding tax on the disposition of U.S. real property interests by foreigners. The most common types of U.S. real property interests are actual real estate, or shares in what's known as the United States Real Property Holding Corporation, which is essentially a corporation established as a real estate holding company. Dispositions can be a little deceiving sometimes because it's not just sales that are covered. A disposition includes sales, it includes exchanges, liquidations or redemptions in the case of a U.S. Real Property Holding Corporation, as well as gifts and pretty much any other transfer by a non-resident alien. So who is a non-resident alien? Non-resident aliens are people who are not U.S. citizens, do not have green cards, and do not meet the substantial presence test. The substantial presence test is essentially where you become a U.S. tax resident by spending a certain number of days in the United States. There's a substantial presence test calculator on our website. Feel free to use it to determine if you meet the substantial presence test or not. If a foreign investor disposes of a U.S. real property interest in the United States, they're required to file a tax return to report the sale or disposition and pay tax on any gains. This is why the United States enacted Firpta, to ensure the payment of tax on gains. And the way they did that is by requiring the buyer of foreign real estate from a non-resident alien to withhold 10% of the sale price and pay it to the IRS. So an example of this is, assume you're selling a property for $500,000. The buyer would have to withhold $50,000 and pay that to the IRS. So you, as the foreign investor, would receive $450,000 and the IRS would receive $50,000. This $50,000 payment will guarantee the payment of tax by the non-resident alien. And when this non-resident alien files their U.S. tax return, if the $50,000 of withholding was more than they actually owed in tax, the difference would be refunded. If the $50,000 that was withheld and paid to the IRS as tax was less than the actual tax owed, then they would owe some money upon filing their tax return. What's interesting with Firpta is it's the buyer's responsibility to withhold the tax, not the seller's. And if the buyer fails to do this, it's the buyer, not the seller, that's responsible for the tax. And they're responsible to pay the tax, late filing penalties of 5% a month up to 25%, late payment penalties of 0.5% a month up to 25%, 3% interest compounded daily, as well as a $10,000 penalty if they knew they were supposed to withhold the tax and didn't do so. Now there are some exceptions to FATCA, and let's talk about what they are. So the first exception is pretty easy. You're not a foreign person, meaning you're a U.S. citizen, a green card holder, or you meet the substantial presence test. If any of those three things apply, Firpta doesn't apply to the transaction. Another exception is if it's a residential property with a value of $300,000 or less and the buyer intends on using that property as a residence for more than 50% of the time over the next two 12-month periods. If that criteria is met, there's also no Firpta withholding. There's also no Firpta withholding on 1031 exchanges. In the United States, we have something known as a like-kind or 1031 exchange. This is essentially where you sell one investment property and roll the gain into another investment property. So if you take part in a 1031 exchange, that's also going to be exempt from FATCA. Also, you can obtain a withholding certificate to reduce or eliminate withholding. For example, Firpta doesn't take into account properties that are being sold at a loss. So even if you were selling a $500,000 house that you had paid $600,000 for, the buyer is still going to be required to withhold unless you have a withholding certificate. Essentially, this is an application that you make to the IRS explaining to them that the property is being sold at a loss. The IRS would then issue a withholding certificate that you would give to the buyer to let them know that they're alleviated of their responsibility to withhold. Finally, if the property is being sold to the U.S. or a state or some government, generally those transactions are not going to be subject to Firpta. Hope this information has been valuable to you. Thank you for joining us. Please check out some of our other segments on our website with other valuable topics.